Okay, let's dive right into this explainer based on a fascinating report from the Londoner News. We're going to start with a really simple but honestly mind-boggling question. How exactly does a massive, stable, beloved staple of the British high street suddenly hemorrhage £1 billion in a single year? I mean, we're talking about a business that sells essential, everyday groceries. It's wild. So today, we're unpacking the Morrisons buyout. We're going to break down the incredibly complex financial engineering behind their recent restructuring. We'll look way past the grocery aisles and dig right into the balance sheets to understand the high-stakes, heavily leveraged world of private equity debt. Here is how we're going to tackle this. 1. The private equity playbook. 2. Target, Morrisons. 3. The debt dilemma. 4. Financial engineering in action. 5. The corporate perspective. And finally, 6. The real-world cost. All right, part 1, the private equity playbook. To get what's happening here, we have to talk about leveraged buyouts, or LBOs. Basically, an investment fund spots a stable business that brings in reliable cash. They buy it using a tiny fraction of their own money and a massive mountain of borrowed cash. But here is the absolute kicker. That debt, it gets loaded directly onto the acquired business itself. So the supermarket, not the private equity fund, is entirely on the hook for paying the interest on its own purchase. Crazy, right? Critics often call this the private equity playbook. It's a highly mechanical, four-step process honed over the last couple of decades. Step 1, buy the company with that massive debt. Step 2, sell off the company's most valuable assets, like prime real estate. Step 3, extract that value to pay down debt or pay dividends. And Step 4, exit the business entirely, usually within 5 to 7 years. Moving right along to part 2, target Morrisons. Back in late 2021, Morrisons found itself smack in the middle of a huge bidding war. Ultimately, the American private equity firm Clayton, DeBillier and Rice, or CDNR, won out. They bought Morrisons in a deal valuing the share capital at about £7.1 billion, which implied a massive enterprise value of £9.8 billion. This was a colossal move, taking a legacy grocer private after 54 years on the London Stock Exchange. Which brings us to part 3, the debt dilemma. Right, so before this whole buyout, Morrisons had a net debt of around £3.2 billion, manageable. But post-buyout, and after acquiring the McCall's convenience chain, that net debt skyrocketed to an eye-watering £8.6 billion. The business was suddenly carrying this absolutely colossal financial weight. Just to put the sheer gravity of that into perspective, by the 2023 financial year, simply paying the finance costs and interest on this new debt pile cost the supermarket a staggering £735 million. So even though the core supermarket was technically generating hundreds of millions in operational profit, poof, almost all of it was instantly wiped out just to service the interest on the debt used to buy them in the first place. Let's look at part 4, financial engineering in action. To handle this crush of debt, they made a massive move in early 2024. Morrisons sold 337 of its petrol forecourts for £2.5 billion. Now, who bought them? A company called Motor Fuel Group, or MFG. And what's really fascinating here is that MFG is actually completely owned and controlled by the exact same private equity firm, CDNR. And this is where you really see the financial shuffle at work. It wasn't just petrol stations. They executed a £331 million sale-leaseback of 76 actual supermarket properties to an investment firm, locking into massive 45-year leases. They also sold and leased back 7 distribution warehouses. So they raise immediate cash to pay down the urgent debt. But the trade-off? The supermarket is now permanently tied into paying long-term rent on the exact same properties it used to own outright. Let's shift gears to part 5, the corporate perspective. Now, from a corporate standpoint, this is framed purely as optimization and growth. William Bannister, the CEO of MFG, says this forecourt deal creates huge synergies. By pooling these assets, MFG is committing £400 million over the next decade to build 800 ultra-rapid EV chargers. The logic is that MFG focuses on fuel and infrastructure, letting Morrisons focus 100% on food retail. And you know what? The financial markets actually validated this strategy. Credit rating agencies like Fitch viewed these debt reduction efforts as a huge positive. Because Morrisons successfully paid down parts of its immediate debt and pushed its debt maturity out to 2027 and beyond, Fitch upgraded their outlook to positive. From a pure survival standpoint on a spreadsheet, the engineering did exactly what it was meant to do: buy time and stave off immediate default.
But we have to look at part 6, the real-world cost.
We're looking at a massive divide here. The corporate owners see synergies, debt reduction, and operational improvement. But critics and financial analysts look at the exact same data and see asset stripping. They argue that loading essential service companies with this kind of heavy engineered debt introduces huge long-term default risks. It leaves behind these hollowed-out companies that are way more vulnerable to economic shocks, like inflation or supply chain issues. And this exact vulnerability was flagged from day one. During the takeover, pension trustees representing over 85,000 Morrisons scheme members were super vocal about their concerns. They warned the deal would materially weaken their financial position, terrified that if bankruptcy ever hit, the pensioners would be pushed to the back of the line behind a massive syndicate of lenders trying to get their cash first. Well, the turbulence did hit. Despite all the asset sales and supposed synergies, the sheer, crushing weight of those finance costs led Morrisons to report a statutory loss of over £1 billion for the second year in a row. The supermarket industry runs on high operating leverage, meaning when your fixed costs, like those shiny new lease payments and debt interest, shoot up, your margin for error basically drops to zero. And the human toll to balance this ledger has been brutal. To manage these costs, the supermarket shed 8,800 jobs last year. That's nearly 8% of its total workforce, gone from retail stores, distribution networks, and the head office. Now, the company noted this was done without forced redundancies, mostly by just not replacing staff who left. But the reality on the ground is a profoundly leaner workforce trying to keep the exact same massive operation running. Finally, amidst all this internal chaos, the market didn't just sit still. Morrisons saw its market share slip down to 8.5%. And with that drop, they actually lost their long-held historic status as the UK's fourth largest grocer, officially getting overtaken by Aldi. Which leaves us with this final, really important question as we wrap up this explainer on the Londoner News Report. The mechanics of the private equity playbook are clear. And yeah, they absolutely work for extracting value and protecting investors. But when you look at the legacy of debt, the selling off of core assets, and thousands of jobs disappearing, is this model truly sustainable for the everyday high street businesses that our local communities actually rely on? It's a massive question, and honestly, it's one that the grocery aisles of tomorrow are going to have to answer.